Hey, I'm Jonathan Wild, and we are going to cover how to record sales of merchandise. In other videos, we talked about purchasing merchandise. Now we are going to shift gears and cover how to resell that merchandise and hopefully generate some net income. Because if we don't, we're probably not going to be in business too long. Before we get into examples, I want to give you a hint that will really help you when recording entries for sales transactions. It is that each sales transaction for a merchandising company is going to have two entries, one for revenue and one for cost. The revenue entry is to record the sale to the customer, and the cost entry is to record the cost of merchandise sold to the customer. So let's dive into an example, and we'll start off with an easier example without cash discounts. Let's say we sold $4,000 of merchandise on credit with terms net 45, meaning no discount is offered and the buyer must pay within 45 days. When recording this transaction, we debit accounts receivable for $4,000 and credit sales for $4,000. We debit accounts receivable to increase the asset account for a payment that is going to be received sometime in the next 45 days. We credit sales for $4,000 to recognize the revenue in this transaction. Now remember that sales of merchandise require two entries. We just recorded the revenue side entry, so now we need to record the cost side entry. Continuing our example, assume the cost of the merchandise we sold was $1,200. To record the cost entry, debit cost of goods sold for $1,200 and credit merchandise inventory for $1,200. We debit cost of goods sold to increase expenses for the cost of merchandise sold to the customer. We credit inventory to record the decrease to inventory. Okay. So now let's take what we just learned and do an example of a sales transaction with a cash discount. Let's say we sold $4,000 of merchandise on credit with terms 215 net 30. This means we offer a 2% discount if we are paid back within 15 days, or the full payment is due within 30 days. On the revenue side entry, we debit accounts receivable for $4,000 and credit sales for $4,000. On the cost side entry, debit cost of goods sold for $1,200 and credit merchandise inventory for $1,200. Now the buyer can take one of two routes. They can pay us within 15 days and take the 2% discount, or they pay us the full $4,000 within 30 days. So let's assume the buyer pays us within the 15-day discount period and takes the $80 discount, which is computed as 2% multiplied by $4,000. Therefore, the total payment the buyer made is $3,920, computed as $4,000 minus the $80 discount. To record cash received from the buyer, we debit cash for $3,920, debit sales discounts for $80, and credit accounts receivable for $4,000. We debit cash for $3,920 to increase that asset for the actual amount of cash received from the buyer. We debit sales discounts for $80 because this is the actual amount of discount we gave to the buyer for paying early. The sales discounts account is a contra revenue account. This means that sales discounts is subtracted from the sales when computing net sales. The sales discounts account is increased through debits, like we did in this entry, and has a normal debit balance, which is subtracted from sales, which has a normal credit balance. Last, we credit accounts receivable for $4,000 to reduce that asset account to zero because the buyer no longer owes us money. Okay, so the entry we just discussed was if the buyer paid within the discount period. Now let's take a look at what happens if the buyer doesn't pay within the discount period, but instead pays within the 30-day credit period. In this case, we receive the full $4,000 payment from the buyer. In our entry, we debit cash for $4,000 as this is the amount received from the buyer, and credit accounts receivable for $4,000 because the buyer no longer owes us for the merchandise.